EPK Capital presents Daily Brief for the 30th of October 2025. Hello, and welcome to EPK Capital's Daily Market Briefing. I am your AI host, Rutvik, bringing you the most critical financial news and analysis from the last 24 hours. The main story on Wednesday was a dramatic reversal. Markets surged to record highs, driven by a relentless AI rally and hopes of a dovish Federal Reserve. But that optimism evaporated in the afternoon when Fed Chair Jerome Powell poured cold water on expectations for more rate cuts this year. This was a classic buy the rumor, sell the news day, complicated by a divided Fed, an ongoing government shutdown, and a major geopolitical shift in U.S.-China trade policy. Let's break down the action. Section 1. The global market levels. It was a story of two completely different trading days. The morning session was defined by pure optimism, while the afternoon was defined by a hawkish reality check. In the United States, Wall Street opened strong, with all three major indices pushing into record intraday territory. The rally was supercharged by another historic day for the tech sector. The S&P 500 and Dow Jones Industrial Average both climbed to new all-time highs during the day. The Nasdaq composite also hit a new record, leading the charge. However, these gains were completely erased following the Federal Reserve's press conference. By the closing bell, the market had given up all its gains to end the day mixed and relatively flat. The surge had been neutralized. Global markets, which closed before the Fed's comments, had a much stronger session. In Europe, London's FTSE 100 was a standout, hitting a new intraday record and closing up 0.61% at 9,756. The pan-continental Stoxx 600, however, finished just slightly lower. In Asia, the optimism was clear. Japan's Nikkei 225 surged an incredible 2.17% to close at a fresh record high of 51,308. The Shanghai Composite in China also rose 0.70%. The exception was Hong Kong's Hang Seng, which slipped by 0.33%. Section 2. The main event, a divided Federal Reserve. The entire market was holding its breath for the Fed's 2 p.m. Eastern announcement, and it did not disappoint in terms of drama. As widely expected, the Federal Open Market Committee, or FOMC, voted to cut its benchmark interest rate by 25 basis points, or a quarter of a percentage point. This lowers the new federal funds rate target range to 3.75% to 4.00%. The official reason for the cut was to cushion the economy against growing risks in the labor market. With job growth stagnating, the Fed is clearly prioritizing its maximum employment mandate over its inflation fight, even with inflation still running above their 2% target. This was not a unified decision. The vote was 10-2, revealing a deep split within the committee. On the dovish side, Fed Governor Stephen Moran voted against the move, arguing for a much larger 50 basis point cut to be more aggressive in protecting jobs. On the hawkish side, Kansas City Fed President Jeff Schmid voted against it, believing the Fed should have held rates steady to continue fighting inflation. This division is critical. It shows the Fed is uncertain about the path forward. Chair Powell admitted the Fed is essentially flying blind. Because of the ongoing U.S. government shutdown, now one of the longest in history, the Fed is not receiving key economic data from the Bureau of Labor Statistics. They are being forced to make multi-billion-dollar policy decisions without the official employment or inflation reports. This is what tanked the market. During his press conference, Powell was explicitly asked about the market's expectation for another rate cut in December. His response stunned the bulls. He said, and I quote, "A further rate cut in December is not a foregone conclusion. Far from it." This single phrase upended financial market bets. Traders who had priced in a third cut as a near certainty were forced to rapidly reassess. Stocks, the S&P 500, which was at record highs, began a sharp sell-off that erased all of the day's gains. Bonds, the bond market's reaction, was even more telling. The 10-year Treasury yield, which had been hovering near 3.98%, spiked. It jumped nearly 10 basis points to end the day, around 4.06%. When yields rise, it means the market believes rates will stay higher for longer. Commodities. In the background, WTI crude oil was relatively stable, trading around $60.50 a barrel. Section 3. The AI Gold Rush. Nvidia smashes $5 trillion. While the Fed dominated the macro story, the single stock story was nothing short of historic. On Wednesday, Nvidia became the first company in history to achieve a $5 trillion market capitalization. The stock surged another 5% as the AI infrastructure boom continues to accelerate. But this wasn't just momentum. It was driven by two major new developments. Nvidia announced it has taken a $1 billion equity stake in Nokia as part of a new strategic partnership. This sent shares of Nokia, NOK, exploding upward by 22.9%. The entire AI-related sector caught fire. Teradyne, TER, which makes test equipment for chips, soared 19% after reporting robust AI-related demand. Microsoft MSFT climbed 2.0% on news of a reworked partnership with OpenAI. In a move that perfectly captures the current moment, Amazon, AMZN, rose 1% after confirming it would be cutting 14,000 corporate jobs. The reason? To free up capital to fund its new AI initiatives. This is a clear sign of a massive capital rotation into artificial intelligence. However, a word of caution came from overseas. The Bank of England's Financial Policy Committee released a statement noting that the risk of a sharp market correction has increased, and that equity valuations, particularly for AI-focused tech companies, appear stretched. Section 4. Political and geopolitical movers. Politics also played a significant role in market sentiment, with all eyes on President Trump's trip to Asia. U.S.-China trade. Hopes. President Trump is scheduled to meet with Chinese President Xi Jinping today, October 30th. In the run-up to that meeting, two major headlines broke. The White House signaled that the two leaders will discuss halving the 20% fentanyl-related tariffs on Chinese goods. This would be in exchange for China cracking down on the export of precursor chemicals. This news was a primary driver of the market's early morning optimism. In a potentially massive geopolitical shift, it was reported that President Trump is considering allowing China access to Nvidia's latest AI chips, like the Blackwell series, as part of a larger trade deal. This would be a huge reversal of previous policy and has massive implications for the tech and defense sectors. In a more direct political comment, President Trump also mentioned during his visit that he is considering Scott Bessent as a potential candidate for the next Federal Reserve chair. Section 5. The Crypto Corner. Finally, in the digital asset space, markets were quiet but firm, holding their recent gains as they, too, waited for the Fed. Bitcoin, BTC, held its ground, trading steadily near $113,000. Ethereum, ETH, also remained strong, holding above the $4,000 level. The wait-and-see approach ahead of Powell's comments was expected, but behind the scenes, institutional interest remains high. The new U.S. spot Bitcoin ETFs saw another $200 million in net inflows, led by BlackRock's IBIT. The Ethereum ETFs performed even better, drawing in roughly $246 million in new capital. This shows that while traders were cautious, the larger trend of institutional adoption continues. Conclusion, your key takeaways. So, to summarize the events of Wednesday, October 29th. The Fed cut rates by 25 basis points as expected, but Chair Powell's not a foregone conclusion comment on a December cut was a hawkish surprise that killed the day's record-setting rally. Nvidia cemented its market dominance by becoming the world's first $5 trillion company, pulling the entire AI ecosystem up with it. All eyes are now on the Trump-Xi meeting, with the potential for lower tariffs and a major reversal on AI chip export bans. The 10-2 vote shows the Fed is deeply split on how to handle a stagnating job market and persistent inflation, especially with no reliable government data. It was a day that started with AI-fueled euphoria and ended with a dose of macroeconomic reality. That's all for this video. Thank you for watching. Be sure to subscribe for your daily market breakdown. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.